morning, ladies and gentlemen. My name is Paweł Toński. I'm tax partner in Crido Taxant, and together with Agnieszka Wnuk, senior manager in our corporate income tax restructuring group, we would like to discuss briefly new legislation in the corporate income tax law, which is quite likely to enter into force as of 2018. This is in fact quite broad change, I believe.
Sure, there is a lot of changes. It's a change of the system, in fact. However, today we would like to rather focus on the selected changes that are, from our perspective, the most important.
Mm-hmm. And I must agree that this is really, I would say, a big change, because since '99, when I started my career as a tax advisor, I would say that I have not seen such important change in the corporate income tax law. Therefore, it's really something which we should carefully prepare for. And what is even worse, in fact, the changes are in vast majority not very favorable for the taxpayers. And I would actually ask, maybe not a typical professional question, but what is the most irritating change for you in the set of changes which Ministry of Finance prepared for us?
From my perspective, there is one change that is for sure very strange and very difficult to understand. This is the change regarding limitation of tax deductibility of costs of immaterial services and licenses.
Okay, so I think I must agree, although there is one probably more irritating change we will discuss at the later stage. But in fact, this is true, because what the ministry is saying now is actually how much intangible services you can buy, and if you buy more, you just cannot deduct those services. So I think this is worth discussing some more details about it, because it's, I suppose, not something really common in the, let's say, European tax system, and I think it's worth to say something more about it, how it works.
Yeah, the change is surprising, as you said. The construction of the new rules is claimed by the Minister of Finance to be based on some European directive. However, it's just the basic rule that may be somehow compared to the directive. But the construction basically is that the taxpayer is not allowed to deduct from his tax base more than 5% of his tax EBITDA over 3 million zloty, being around 700,000 euro. And this limit concerns the expense of services called intangible services, but in particular these are advertisement, advisory, management services, and different kinds of license fees.
Yeah, but unfortunately there is at least one, maybe not a very good news, but good news, that it only applies to related parties.
Yes, this is what the minister decided to do.
After some discussions.
After some discussions, because the first draft law regarded both related and unrelated parties. Today, this limitation concerns only related parties. However, it's still a very restrictive rule. There are some options for this rule not to be applicable, namely two major. First one, if the acquired services or licenses are directly connected with the goods or services being sold by the taxpayer. So if there is a direct connection, then we may claim that this limitation is not applicable. It is not clear, however,
what it means
and how direct this connection should be. There is in current wording of tax law, there is a definition of direct costs. We understand that this is not the intention of the minister to treat this direct connection as we used to understand it. However, it's not clear. And the second option, also introduced lately after lots of discussion and after being criticized, it's when the taxpayer has APA, advanced pricing agreement with the ministry, and if this APA covers the services and the licenses, then the limitation does not.
Is not applicable.
Apply.
Okay, so if we can sum up briefly, this first main change is if you buy services from related parties, and those are, I would say, all kinds of intangible services, including management or advisory or advertising, then you can only deduct up to 3 million zloty, roughly 700,000 euros, and 5% of EBITDA, of tax EBITDA, which, when we discuss those changes with the taxpayers, multinationals, this is usually not sufficient, especially for highly specialized multinationals which have shared service centers, and the amount of services paid internally is quite high. So this is, I think, quite, important change and probably quite burdensome for taxpayers.
Yes, and this is why there is so much discussion about it.
Yeah, it was probably the one which was most heavily criticized internally in Poland.
Yes, but despite this criticism, the Ministry of Finance decided to leave this idea, and yes, it will probably start to be applicable from the next year.
And that change alone would be quite significant, but we have more, and there is one more limitation of costs which we can deduct. This change concerns financing, and again we have the similar approach. In this case, I think we really can, let's say, believe the ministry that this is based on the directive.
Exactly. In fact, the new rules regarding financing, limitation of cost of financing, is based on the EU law, meaning Anti-Tax Avoidance Directive, and the idea, the mechanism is similar. So the taxpayers are allowed to deduct from their tax base the surplus of the financing costs. Over 3 million, 3 million is a safe harbor, and over 3 million, the limit is 30% of tax EBITDA. So the mechanism is based on EU law. However, EU directive provides for a safe harbor at the level at 3 million euro. And here we have 3 million zloty, which means
the amount is the same, but the currency is slightly different.
Yes. So it's 1/4.
And what's important, I think, this limitation applies to both internal financing, which probably would be more or less obvious, but also to bank financing.
This is something new, because currently applicable thin capitalization law limits the costs of financing, which result from the intragroup financing. Now we will need to take into account also the bank loans.
And again, the directive gave some options to the governments to exclude bank financing from the rule, but we just didn't take this option.
Yes, and there is also an option for grandfathering rules in the directive to be applicable to all financing granted by mid-2016, and in Poland, and with no limit for the future. And in Poland, we will only have grandfathering rules applicable by the end of 2018.
Yeah. So again, if we have the interest or any other financing costs, we can deduct 3 million zloty, then 30% of EBITDA. If we have old financing, we can use the old rules, but only till the end of 2018. and the rule concerns internal financing and bank financing, so goes quite far. And it's not the only rule which is concerning financing, which was introduced by the ministry, because at the very last stage of preparing the draft, ministry added something which limits the debt push down. And if I may add to what Aga was saying about those rules, and the ministry said, if you acquire the shares and you have the financing to acquire those shares, then the interest may be generally deductible, but if you do some restructuring later on, which allows you to combine the cost of financing with the operational revenues of the target of the company which you bought, so if you merge or if you convert the company, the target company into tax transparent entity, or if you form a tax capital group, then you cannot deduct the interest at all, not even within those limits of 30% EBITDA. It came as a surprise, I must say.
Yes, it was very surprising because now we have the situation when, depending on the way of acquisition, we have different different tax situation. Because if we buy shares and then merge, which is quite common way of acquisition.
And I would say it would exist and will exist even if there is no taxes, because it's not only driven by taxes. I would say it's driven by just nature of how the financing should be linked with the revenues it finances.
It's quite often also the bank's
requirement. The banks require that. Mm-hmm.
And on the other hand, if we acquire enterprise and the company acquiring is financed by loan, it has different situation.
Mm-hmm. So in other words, the ministry, for a reason, prefers that the transaction on the market are done through acquisition of the enterprise and not through the acquisition of shares, which is, of course, I mean, the acquisition of enterprise is by far more difficult because there is no full succession of all rights and permits and contracts. So definitely it's not easier for the business.
I think there is also one more change also introduced just during the parliamentary works that is very important, and it relates to intercompany loans. Here the new law says that when assessing the financial rating of the company that has the financing from the group, for transfer pricing purposes, the tax authorities will disregard the fact that this entity exists within the group. So any guarantees provided by the group or the fact that the company is within the group should be disregarded for the purposes of assessment of market financial standing, which is obviously illogical and wrong, because when we go to the bank and ask for financing, when the company, for example, newly created company, goes to the bank and asks for the financing, the bank for sure will take into account the fact that it operates within a group.
Of course, even if the company is privately owned, like by individuals, then the individuals would have to give the guarantee to the bank that the company will be able to pay the debt. So we actually have a massive attack on the financing cost because we have limits on 30% EBITDA, limits regarding deductibility only up to 30% EBITDA. We have no debt push down anymore, and which this rule is not fully clear for me how this will be interpreted, but we may potentially have, let's say, a tool, or the authorities may have a tool to challenge the intra-group financing, even if this falls within the limits of 30% EBITDA, because by saying that this financing is above the credit capacity of the company.
So-called market credit capacity,
which is undefined and will be probably defined in future through discussions with authorities. So it's tough on financing, and there is one more, I would say, revolutionary change, namely we introduced the buckets of revenues.
Yes, in particular the capital gains basket has been separated. Up till now, capital gains and capital losses are pooled with operational income.
So it was just like one income.
Yes, it's so just one income and 19% on total income. And starting from the next year, we will need to tax the capital gains or settle the capital losses separately. So it will not be possible to set off the capital loss, for example, with operating income.
Yeah, because now if we have gains on the sale of goods or products, and at the same time in the same tax year we have a loss on the sale of shares, it is pulled together, so the loss actually offset the gain. Starting from 2018 we would have a gain on the operational income, and the loss on the capital gain is just kept separate from the gain on the operational income. And what is in those capital gains? I think it's worth saying.
Yes, there are basically dividend-like incomes, all kinds of dividend incomes. Then we have the revenue on sale of shares of the company, the revenue on sale of the partnership, all in-kind contributions to the company, and also some kind of licenses, which could not be very obvious, but it's also in this catalog. And on the other hand, we need to match these revenues with the costs. When it is possible, we will need to have the direct connection, and for the general costs, like overheads, we will need to apply a ratio, a revenue ratio.
Mm-hmm. So if we say that we look how much revenues we get from the operational income, how much revenues we had from the capital gain source, and then we split those costs proportionally to those revenues, which may be quite volatile. I mean, if we if we have a regular operational income and once, I don't know, in 3 years we sell shares, then this may really be significantly different than in the years when we don't have the sale of shares.
If we have our own office building and amortize it, then we'll need to split probably in the amortization.
What is, I would say, good in this context is that the past losses, so the losses which are incurred until the end of this year, will still be settled based on the old rules. So in other words, we will sum up the results, the taxable income, so the gain from the operational and the gain, let's assume from the capital gain source, and then on the top we will have the taxable income, and then we'll reduce it by the loss incurred until the end of 2017. Yes. That's how it's going to work, right?
So here then the minister was quite nice to us and didn't make us separate the losses.
The past losses,
the past
which would
losses.
be quite difficult. Yeah. But of course the new losses, so the losses starting from 2018, they will be kept in the particular sources of income. So if you have an operational loss, it can only reduce the gain in future of operational gain. And the same, if you have a capital gain loss, it can only reduce the capital gain income in future. So this again is I think major change. One change which I was at the beginning saying to Agnieszka that for some maybe more irritating than the one about the services is a so-called minimal tax on the on the real estate, but only on a very specific real estate. It's like on office buildings and shopping malls only.
And most valuable, as the minister says, meaning
over 10 million zloty.
Over 10 million zloty.
So what we have, it's quite difficult actually to discuss it about it in the context of the corporate income tax law, which is in its name has an income, because this tax is actually like a wealth tax, I would say, because you pay it if you have the property which meets the criteria, you pay it even if you don't have the income. That's how it works.
Yes, this argument was even discussed during the parliamentary works, that it's in fact a second real estate tax, because we have one real estate tax. Real estate tax, yes. And now we'll have the second called income tax, and the difference is that we can just deduct this income tax, this minimal income tax, from our income tax, regular income tax.
Yeah, so exactly it works like this, that if we always pay whatever is higher. right? If our corporate income tax is higher than the minimal income tax on the property, then we pay the corporate income tax. But if we have a loss on the corporate income tax, then we pay the minimal tax on the property, on this property.
Yes, and the tax is paid monthly.
Monthly, yeah. The tax is paid monthly, and this is 0.42% per annum, which means that on, simplifying a bit, on 100 million property, we pay 420,000 of tax, which means that actually in 22 or something years, we will just pay the value of the property in this tax.
Irrespective of whether we have
income or not. And so from the perspective of owners of the shopping centers or office buildings, I think this may be even more irritating than the services. Yeah. Yeah. And as we discussed, it's obvious that the most changes are just, let's say, favorable for the government. There are some minor changes which would be probably beneficial for taxpayers. The tax capital group is probably something which we agreed that this is the most helpful, so to say.
Yes, because now it's difficult to create the tax capital group.
Create and maintain status.
Because the requirements are quite restrictive. And here the minister says that some of the conditions will be easier to be met.
Easier to be met, yeah. So this may be a good news. What is even better news in this context is that the limits on services, which we discussed at the very beginning, is not applicable to companies within the tax capital group. So again, this may be slightly more encouraging to use it. But the changes in the law are one thing which we just preparing for this conversation discuss that this is important, and certainly the impact will be huge. But I think it's good to use this occasion to discuss also the change in the tax environment as such in Poland, because it's also been changing recently.
Yes, the approach of tax administration that we observed during the tax audits has changed recently, and it in particular concerns the transfer pricing. So for audits, we observe that the tax auditors to be much more focused than they used to be. So although we have less tax audits in the number, yeah, the value of tax assessment is higher.
And I think they come prepared. I mean, we very often see that they actually already know what the company was doing, and they like focus on particular operations, reorganizations, restructurings, some financing, and so it's never been like that. It's changed like 2 years ago, something like that. Right?
Yes, and it looks like sometimes like organized actions. So yeah, they have a favorite topic, and they try to look for the assessments in the taxpayers in the companies from the same branch, for example.
And they do the homework. I mean, they really come prepared. So this is maybe not something resulting from a direct change in the rules, but it's something, I think, which reflects the change of attitude of the Ministry of Finance. One could say that this is a positive move from the perspective of, let's say, overall perception of how the authorities should work, because they really, as we said, come prepared now. But certainly it also means that for taxpayers it's more difficult to live within the tax audit.
Especially if the tax auditor receives some instructions and tries to apply them
blindly, without really thinking whether it applies here. But that's true. But we've seen such situations in the past, that they follow the instructions too, I would say, too eagerly, not always being able to distinguish the differences between the bad situations and the regular situations. I think this is all.
These are the major changes. And the draft law is quite extensive, like 80 pages, I think, of the new rules. But we only wanted to present, to discuss the most important, most irritating.
Yeah, most irritating probably. So as we said, this is all on our site. Thank you very much for listening. We are a bit sorry that most of the news are, let's say, not necessarily very happy, but this is how it is, and we look forward to hear from you if you are interested in those rules. Thank you very much.
Thank you.
Thank you, Ania.
Thank you.